What is up, guys? Welcome back to week 10 of Stocks and NFTs here on the Mcubed channel. Movies, money, marijuana. But before we start, a short disclaimer. I'm not a financial advisor, nor do I claim to be one. Everything said here is for educational and entertainment purposes only. That being said, these are my opinions, so feel free to disagree in the comments down below and let me know what you think. For today's video, I'm going to be talking about hedging and how it could help you minimize the risk in your investment portfolio. But these strategies do come at a cost, and while hedging is a risk reduction strategy, a poorly managed hedge can actually put you in a worse position than taking on the risk yourself. So what does hedging mean? When we hedge an investment, we reduce or eliminate certain risks that could negatively impact our holdings. The practice refers to reducing some sort of risk or exposure in our portfolio. It can be the risk of a specific stock or an industry experiencing a decline, the risk of interest rates rising, or even the risk of inflation being higher than expected. So how is hedging done? Hedging is done by adding investments to our portfolio that move in the opposite direction of what we're trying to manage. In other words, we're trying to achieve a negative delta or a -1 correlation to our current exposure, which is just a measure of how much one asset moves whenever the other changes by $1. This ensures that if the event does happen and our holdings do lose value, the new asset will appreciate, therefore offsetting the decline and providing some sort of protection. As an oversimplified example, an investor could hedge their exposure to a specific stock by shorting that same position. By doing this, they offset their downside. If the stock falls in value, the short position will increase in value, offsetting the decline of the long position. Now, this might sound perfect for a no risk involved strategy, but since you avoided any downside, you are also preventing yourself from achieving any gains. Most investors instead focus on hedging specific risk or exposures. This way they aren't completely eliminating their upside, but they are still protecting themselves from certain losses that they don't want to have. Other risks an investor might look to hedge include interest rates, risk equity, risk commodity, risk inflation, and many more. But while some of these can be offset using specific stocks or gold in the case of inflation risk, how exactly does one hedge against changing interest rates or changing exchange rates? While it's technically possible to hedge these risks through more traditional investments, with explicit hedges are often accomplished using what is called a derivative. Derivatives are securities that derive their value from an underlying asset or benchmark. Common derivatives include futures, contracts, forwards, options, and swaps. Most derivatives aren't traded on exchanges and are used by institutions to hedge risk or speculate on price changes in the underlying asset. But at a high level, a derivative is simply a contract where you enter a bet or an agreement with another investor about which direction some underlying asset, rate, or factor will move in the future. The underlying asset can be a commodity, a currency, a stock, an interest rate, or even an index. And to hedge something with a derivative, you simply bet against the thing you have exposure to. Another popular and enticing derivative is the put option, which is a security that lets you sell a stock at a specified price at some point in the future when owned. Alongside the stock itself, this type of option is the closest thing you can get, and for lack of a better word, an actual insurance policy on a stock. For example, imagine you have a share of X stock worth $100 and you put a put option with a strike price of $95. This means that no matter what the stock price falls to, you can sell the stock for $95 even if the share becomes worthless. You've entered a contract where you can sell to someone else for that predetermined price. Derivatives let you do something interesting with your holdings. For example, it's possible to hedge your market risk while still maintaining exposure to specific stocks. This is technically done by shorting an index feature such as the S&P 500, and by doing this you negate the impact the stock market decline would have had on your portfolio while still having equity exposure. Now this looks like a strange and not a very practical tactic, but these strategies like this are actually fairly common among hedge funds, which are a specific type of fund that only accredited investors have access to. Hedge funds frequently long some assets while going short on others, with the intent of earning a return regardless of what the market as a whole is doing, hence the name of the fund. While these vehicles aren't accessible to everyday investors, individual investors can technically carry out the same strategies by buying their own options, shorting certain positions, and altering the risk-return features of their portfolio as a whole. But hedging isn't the solution you might expect it to be, and there are some cons you should understand before you go ahead and start changing your whole portfolio. First of all, hedging can be a really complicated strategy to maintain. Depending on the risk you're trying to hedge, you'll need to calculate one of the 5 Greeks. But the problem is that these measures change every time the underlying value changes. The point is that if you want to keep a consistent hedge, you'll need to continually adjust your positions, which can be difficult and time consuming. Derivatives can also be very risky investments. To work with options and futures can sometimes actually add risk to the portfolio, as I mentioned in the beginning. And if you don't know how to manage them properly, you'll take on a higher risk than you intended for. Secondly, most hedges are only temporary. Put options, futures, and swaps all mature or expire at some point in the future. So maintaining the hedge over time requires continually rolling your money into new positions. Finally, hedges in one way or another can be expensive. Either you'll be paying a premium like with an option or future, or you'll be hedging your upside along your downside. And while there's nothing wrong with investing in certain stocks to limit your risk exposure, trying to supplement your entire portfolio to protect yourself from likely declines can be complicated, time consuming, and expensive. Well, that's it for today's video, but to recap, hedging simply means to offset the risk of any unfavorable price movement in the market. But if the investment you are hedging against makes money, you have also reduced your potential profit. Well, I hope this video did help you understand what hedging means, and I'll see you next week here on the Mcubed channel.